Welcome to our weekly Forex forecast. We need to remind you that trading Forex is a risky endeavor and not suitable for all investors. My name is Jay Norris. I've written a couple of books on trading which serve as the textbooks for our courses, and I'm also the Director of Education at trading-u.com, where I spend a considerable amount of time teaching and demonstrating the art of discretionary trading in live markets. Going to the charts, first market we're covering is the Australian US dollar. The one thing that pops out at me on the charts, other than the fact that you have these long-term patterns higher, is that longer-term structure in the way of resistance, in the way of that trend line up above the market. You have to respect that trend line. Because of that trend line, we're looking at this market the same way we looked at it back in late July, that it's just not worth the risk for us currently to be long this market above 104. If it breaks out, it's going to break out without us. We'll have to reevaluate that and perhaps look at buying a dip. But for now, we're much more interested in buying a dip back towards 102 or even in the 101 handle. So let's see if that resistance holds. From a short-term trader's perspective, of course, we have to look at buy setups much sooner than that on the intraday charts based on just that secondary pattern, that day-to-day pattern, number 4 and 3 being up alone. That's enough of a reason for us to follow it on the longer-term charts. But from a longer-term perspective, more from the investor's perspective, for now, we're going to hold out for a dip because the market's still below structure. Next market, Aussie yen. You're in a similar situation in the Aussie yen. You know, for all the fireworks last week where the majors really just blew through on the upside, because first you had the support of Mario Draghi, who the markets respect. Certainly the markets respect the European Central Bank. And as to emphasize that also, you had Chairman Bernanke following up with, of course, QE3 last week. That was much anticipated. So really the central bankers in control and doing what they need to do to keep these markets propped up, i.e. the euro, the U.S. stock market, and I think a residual effect of that is going to be a strong Aussie yen also. However, in this market, you really didn't eclipse that significant level in the summer. You couldn't get beyond it. You're not even to it too. You know, again, all the fireworks last week, you would have thought you would have got to that 84 level. You didn't. So we see this for now as a sign of weakness. It's not as strong as it could have been. So we're more interested in buying dips. If you're long this market, you're long the Australian dollar, you got that good yield to it, particularly in a Forex account at 50 to 1. So we're always interested from a longer term perspective of buying the big dips. On the other hand, from our perspective, it just doesn't warrant the risk of being long at these levels until you can eclipse that 84 level at least a couple of times on the daily chart. So stay tuned. Next market we'll take a look at is the Euro-US dollar. Euro-US dollar, you know, they came a long way in the past week, certainly, and there's the fireworks we're talking about, where you had the week before Draghi goosed it, and then this week Bernanke really put the short's tail to the fire. We don't necessarily see this as a whole lot of new buying, although you sure had short-term speculators in there, I'm sure, on the long side. We see it more as longer-term hedge fund traders just getting smoked out. You know, you have to take a central banker seriously when, in the case of Mario Draghi, he said about a month ago, he said it just doesn't make sense to be short the euro. Basically warning traders, and boy, wasn't that warning apropos, because the market sure is a lot higher now. Now, from a technical perspective, we could see the primary pattern is still down. And let's take a look at a very similar move in October of last year, where you had a big short covering rally and you torched the U.S. hedge funds who happen to be short that. And if you take that measurement, low to high, and you compare it now to the low to high, look at that. It's almost on to the pip, where you see that move, the height of that move pretty much equals the height of this move. So my point being, it's not out of character for this market at all. It's certainly within the technical boundaries that this market's laid out for itself over a year. So from our perspective, I don't think we get too excited about this up move. I don't think it's a sea change move. I think it's just another bear market rally. in an overall bear pattern, and you can see it there how that primary pattern is down. So long term, they took it a little bit further than they may have for all the shorts in that market, but I still see it as a short covering rally. I've seen this many times over the last 30 years where you have a big player who's trapped in a market, and he's going to try to wiggle out of it, and it just doesn't work that way. Until that mammoth sinks below the tar pit and leaves, you see that last bubble of air popping up in the tar pit. Until that guy's dead, you're not going to turn that market around, basically. So we refer to this as the mammoth in the tar pit, and I think the mammoth itself is some of these big U.S. hedge funds. So until they're smoked out, you may not necessarily turn this market around until then. But I think the market will respect the primary pattern from these levels now. I think we do better to be patient and wait for potential sell setups in line with that primary pattern. Not that we're advocating picking a top, a tricky business. But overall, I think the longer term, I don't see a whole lot of upside necessarily. But as always, you have to have an open mind. So, hard for me in my position to come right out and say, hey, sell this market. That's not how we roll. You definitely need some indications of weakness. So I guess my point being, you're definitely at an area where you start to look for those indications of weakness. Let's take a look at the let's take a look at the Euro Aussie. And here's another interesting one where the primary pattern is down, and in this case the secondary pattern is still down also. So Euro Aussie may be another interesting candidate where we're not advocating picking a top by any means. You need to see weakness in the market, but at the same time, this is one to watch for longer term sell setups where it may be worth it to step out and do a little counter trend trading against this predominant pattern right here, against this rally right here. Again, I just took the measurement of the correction, the bear market rally from February to May, from the late winter to the spring, and we took that measurement, and you can see we measured it here, and essentially it's telling us that this correction from height-wise, from distance-wise, is really right in line with the last correction. So it's really no great shakes, and I think pointing that out helps us to understand that this isn't by any means a sea change move just yet. In fact, it's probably a move that you could start to consider fading closer to, in the high 125 handle on the approach to 126. Next market, pound dollar. We like pound dollar overall. It's an awful strong move. It never quite gave us a dip, though. We think longer term that you could potentially see 170 in this market. And when you pull up a weekly, you see that's really not a stretch. That was the 09 high, that dead cat bounce in 09. So we think you could see that. But we certainly don't want to jump right in and ride it at these levels. We think that because you had a big move, you look for a bigger retracement. That's how essentially we approach it. We think you have a retracement that would be in line with this large move. So, we want to see how this guy plays out, but at the same time, we don't want to buy in on too shallow of a retracement, because a big move is, guess what, it's going to give you a big retracement. So we'd be looking forward to that big retracement. So potentially, if we see the euro start to come off, if you see that Euro Aussie trade start to develop, you may see the pound go down in sympathy with that euro. We think it's a buy opportunity in the pound, not so in the euro. Pound yen's a market I like to buy dips in this market. You had a massive up day as dollar yen looks to have potentially reversed itself, and so you had the combination of a great trade, strong pound, weak yen. That's exactly what you want to see for a pair like that. That's how you have a big day like that. So we like this guy overall, but again, it's a trading vehicle, not necessarily an investment vehicle just yet. But if you can get a dip in here, and depending on your risk reward too, depending on how much you risk on that trade, it may be worth it. You may be worth it to go in a little bit early and risk a bigger drawdown, because if you look at the reward on this, if we think you get to 160, you're currently a little below. You're at 127. 160 is a long way off. So you have to look at this guy from an investor standpoint as well as a good trade too. So if you get a dip in this market you have to take a good look at it. If you can take the summer low there and kind of retrace that, let's imagine if they get it as high as 128, then maybe a dip somewhere towards 124 would be welcome. So keep in mind, big moves, big rallies tend to have big retracements. So stay patient. I think at some point between now and the end of the year, you'll get a big dip in this market, and we'll be on top of it. We're not going anywhere. We'll show you this market as it continues to evolve. Next market, the Kiwi. Boy, the Kiwi has just been an outstanding performer. There it is. We drew that line on there. That's Mandelbrot's curve. We call that. Essentially, we just took this move, and you guys are probably familiar with that ABC move, or Mandelbrot called that his generator. He refers to that as the base pattern in trading, which when replicated creates the more complex patterns that we see that tend to confuse us all about what the market's going to do. And there it is. It was just a replication, that move, then the pullback, and then that move's replicated. So interesting. It looks like that move, having been the equal of this move, maybe also coming to a break there also. Let me check one pattern line also longer term. Oh yeah, look at that. You're right at what we refer to as a pattern line, as resistance right there. So it looks like potentially this market could be topping out too. We loved it. It was a beautiful move, just a moonshot coming out of there. But and there you go. You can see on the daily chart, you actually put in a shooting star on that critical resistance level for us on that pattern line. So this is probably a guy that we can look to retrace. We'll definitely look to revisit this guy on the dip, though. Keep in mind, big impulse moves tend to have big retracements. So you don't want to nibble too early on a shallow retracement following what essentially, from our perspective, was really the extension of a low volume August rally, a low volume summertime rally, and you see that a little bit more clear in markets such as the euro and the Aussie. The chief next, dollar Swissy. Secondary pattern is down. We have a question mark there. Generally, we want to see two closes below that critical level. You have one. I imagine you'll get the second. So this is an interesting one where they drilled that secondary pattern. On the other hand, the primary pattern is still up. Your short-term primary is still up also. So a move into the 90 handle may be in the cards for now. We'll have to see. This guy may have a little bit more downside to it looking at that momentum you're looking at now. So dollar chief could have a little bit more downside to it. Let's take a look at the yen itself. I'm always a little perplexed at this chart. Not sure what to make of this rally itself. Although the standard company line here is, we do have a higher low here. This formation is a higher low to that, so that's worth something. Now, this turnaround, this change of direction right here, that key reversal on the daily, that's going to be big. On the other hand, we've seen them before fail, so let's watch this guy. But I think that this market is in the process of bottoming out. Let's look at it on a weekly chart. There you go. I think potentially it is in the process of bottoming out. Nice looking hammer there. And if it is, this is what's most exciting about dollar yen is going to be the trade in the yen pairs overall. You get a weak yen, i.e. a strong dollar yen. This is the dollar yen chart. So you see a strong dollar versus a weak yen. That's going to make for great trade in some of these other yen pairs where, if these majors pull back and you see a little bit of mean reversion activity in the majors, you could still have pretty good rallies in the yen pairs if and when dollar yen recovers. So this is another one that we need to keep an eye on pretty much all the time. Thanks again for attending. My name is Jay Norris. I'm the Director of Education at trading-u.com. If you want to check out our site, you click on the education button and you can see some of the freebies we have in there. You can enroll for a free core concepts course with us, and you could sign up also by clicking that education button for our live market analysis, where we'll do that this coming Monday on the London US overlap. You can come in there and you can see us point out trade signals and setups in live markets on those intraday charts. Hey, we look forward to seeing you there, and if not, we'll see you midweek or so for the midweek Forex forecast report. Thank you.